Ladies and gentlemen, today I want to talk to you about something that can change your financial future investing in stocks. Now, I know the stock market can seem intimidating, especially if you're just starting out. But let me tell you something, investing doesn't have to be complicated. In fact, with the right mindset and a little discipline, anyone can build wealth through stocks. So let's break it down into simple, actionable steps. 1, start with the basics, understand what stocks are and how the stock market works. Before you dive into investing, it's crucial to understand the fundamentals. A stock represents ownership in a company. When you buy a share of stock, you own a small piece of that business. If the company grows and becomes more profitable, the value of yours can increase. Conversely, if the company struggles, your investment may lose value. The stock market is where these shares are bought and sold. It's a marketplace where investors come together to trade ownership in companies. Major stock exchanges like the New York Stock Exchange, NYSE, and Nasdaq facilitate these transactions. But how does it all work? Companies go public through an initial public offering, IPO, selling shares to raise capital. Once the shares are available on the market, their prices fluctuate based on supply and demand, company performance, and broader economic factors. For beginners, it's important to understand key concepts like market capitalization, the total value of a company's outstanding shares. Large cap companies like Apple and Microsoft are typically more stable, while small cap companies may offer higher growth potential, but come with more risk. The dividends, some companies pay a portion of their profits to shareholders in the form of dividends. These can provide a steady income stream. Volatility, stock prices can swing dramatically in the short term. This is normal, but it's why long-term investing is often safer. Take the time to learn these basics, read books, follow reputable financial news sources, and consider using virtual trading platforms to practice without risking real money. The more you understand, the more confident you'll feel when you start investing. 2, set clear financial goals, know why you're investing. Investing without a goal is like driving without a destination, you'll end up lost. Before you buy your first stock, ask yourself, what am I trying to achieve? Your goals will shape your investment strategy. Are you investing for retirement? If so, you have a long time horizon, which means you can afford to take on more risk in pursuit of high returns. Are you saving for a down payment on a house in the next 5 years? In that case, you'll want to focus on safer, more stable investments. Here's how to set effective financial goals. Be specific. Instead of saying, I want to be rich, say, I want to save $500,000 for retirement by age 65. Make it measurable, track your progress. If your goal is to save $10,000 in 5 years, break it down into smaller milestones. Be realistic, don't expect to double your money overnight. The stock market historically returns about 7 to 10% annually adjusted for inflation. Set a timeline short on goals. 1 to 3 years require more conservative or pre-years, while long-term goals, 10 years, allow for growth or growing-oriented investments. Your goals will also determine your risk tolerance. If you're investing for retirement farm in 30 years from now, you can afford to ride out market downturns. But if you need the money soon, you'll want to prioritize stability over growth. 3, invest in what you understand, avoid complex investments. One of the biggest mistakes beginners make is investing in things they don't understand. Whether it's a trendy tech stock, a cryptocurrency, or a complicated financial product, if you can't explain how it works, you shouldn't invest in it. Warren Buffett, one of the most successful investors of all time, famously said, never invest in something you cannot understand. This principle is especially important for beginners. Stick to companies and industries you know. For example, if you work in healthcare, you might have a better understanding of pharmaceutical or biotech companies. If you're a tech enthusiast, you might feel more comfortable investing in software or hardware companies. Here's how to apply this principle. Research the company, look at its business model, products, and competitive advantages. Does it have a strong brand? Is it profitable? Does it have a history of growth? Avoid fads. Just because everyone is talking about a stock doesn't mean it's a good investment. Remember the dot-com bubble of the late 1990s. Many investors lost money because they chased hype instead of value. Keep it simple. You don't need to invest in exotic financial instruments to seed. Start with individual stocks or index funds, which are easier to understand and manage. By focusing on what you'll know, you'll make smarter, more confident investment decisions. 4, diversify your portfolio, put all your eggs in one basket. Diversification is one of the most important principles of investing. It means spreading your money across different types of investments to reduce risk. If one investment performs poorly, others may perform well, balancing out your losses. For example, if you invest all your money in a single tech stock and the tech sector crashes, you could lose a significant portion of your portfolio. But if you also own stocks in healthcare, consumer goods, and energy, the impact of a tech downturn will be less severe. Here's how to diversify effectively. Across industries, invest in companies from different sectors such as technology, healthcare, finance, and utilities. Across asset classes, consider adding bonds, real estate, or international stocks to your portfolio. Through index funds or ETFs, these funds track a broad market index, like the S&P 500, and provide instant diversification. Remember, diversification doesn't guarantee profits or protect against all losses, but it does reduce risk. As the saying goes, don't put all your eggs in one basket. 5, think long-term, avoid the temptation to time the market. The stock market is unpredictable in the short term. Prices can swing wildly based on news, economic data, or even investor sentiment. Trying to time the market buying low, selling high is incredibly difficult, even for professionals. Instead of chasing short-term gains, focus on long-term growth. Historically, the stock market has trended upward over time, despite periodic downturns. I stand periodic downturns, expect periodic dip downturns. For example, the S&P 500 has delivered an average annual return of about 10% over the past century. But this growth doesn't happen in a straight line. There will be ups and downs along the way. Here's why a long-term mindset is crucial. Compound growth, reinvesting your earnings allows your money to grow exponentially over time. Lower stress, you won't feel the need to constantly monitor your investments or react to every market fluctuation. Better returns, studies show that long-term investors tend to outperform those who trade frequently. So be patient, invest consistently, and let time work in your favor. 6, start small and be consistent, build wealth over time. You don't need a lot of money to start investing. Thanks to fractional shares and low-cost brokerage platforms, you can begin with as little as $50 or $100. The key is to start early and invest regularly. Here's how to get started. Set a budget, decide how much you can afford to invest each month. Even small amounts can add up over time. Automate your investments, set up automatic transfers to your brokerage account. This ensures you stay consistent even when life gets busy. Reinvest the dividends. If you own dividend-paying stocks, reinvest those payments to buy more shares. Consistency is more important than the amount you invest. By starting small and staying disciplined, you'll build wealth over time. 7, avoid emotional decisions, stay calm during market volatility. Morgan Allen. Investing can be emotional. When the market is up, it's easy to feel overconfident and take on too much risk. When the market is down, fear can lead you to sell at the worst possible time. To avoid emotional decisions, stick to your plan, have a clear investment strategy and follow it regardless of market conditions. Focus on the long term. Remember that market downturns are temporary. Historically, the market has always recovered. Check your portfolio too often. Constantly monitoring your investments can lead to unnecessary stress and impulsive decision sets. By staying calm and disciplined, you'll make better investment choices. 8, educate yourself continuously. Keep learning and growing. The world of investing is constantly evolving. New technologies, industries, and financial products emerge all the time. To stay ahead, you need to keep learning. Here's how to stay informed. Read books and articles. Start with classics like The Intelligent Investor by Benjamin Graham or Common Stocks and Uncommon Profits by Philip Fisher. Follow reputable sources. Stay updated with financial news from trusted outlets like the Wall Street Journal, Bloomberg, or CNBC. Join communities engaged with other investors through forums, social media groups, or local investment clubs. The more you learn, the more confident and successful you'll become as an investor. Investing in stocks is one of the most powerful ways to build wealth, but it's not a shortcut to riches. It requires patience, discipline, and a willingness to learn. By starting with the basics, setting clear goals, and staying consistent, you can achieve financial success over time. Remember, the journey of 1,000 miles begins with a single step. Take that first step today, and you'll be amazed at how far you can go. Thank you.